Hello and welcome to the 2025 spring presentation here by Birchwood Capital. My name is Matt Higbie. I'm excited to walk you guys through some slides today, just talking about our investment philosophy and some recent events and questions we've gotten from clients. So hopefully you find this helpful. And just a quick overview of what we're going to walk through today. We'll touch on our investment philosophy, passive, diversified, long-term being the key tenets there. Talk about market volatility and some of the recent events. Talk about valuation and concentration and some key drivers of long-term performance. And then lastly, U.S. versus international and just some topical events that have been getting headlines like the debt situation and some tariff concerns that have driven market volatility. And so just to start, we thought this quote from Paul Samuelson really hit the heart of how we think about investing here at Birchwood, and just that it should be dull and should not be exciting. Like we touched on the first bullet on the last slide, we focus on diversified strategies and passive investing, neither one of which is very exciting, but both tend to work very well over time. And similarly, really focusing on a long-term time horizon with a buy and hold mentality of owning things for the long term, because this tends to lead to the best performance, even if it's not always the best winner over a very short time horizon. Another key part of our philosophy is controlling what we can control, or rather control the controllables. And so, for example, things like fees, things like transaction costs from trading, and tax liabilities, saving and spending levels by our clients, and just having a plan and being prepared for a range of outcomes and potential future scenarios, we think are all things that we can control and tend to help our clients maximize the odds of success in achieving their financial goals. And so, like that last bullet says, we don't know what the future holds, but we try and do everything we can here at Birchwood to help our clients maximize the odds of success by doing things that are within our control. Another part of our investment philosophy we wanted to hit on again was this concept of the war chest, which is really two parts, as you can see here on the slide. The first one being the emergency fund, which is having cash on hand for 6 months of living expenses. And the thought there is just avoiding any need to take on expensive debt to solve any near-term cash flow problems for things like house problems, car problems, health problems, things that happen from time to time that we can pay for with cash on hand rather than needing to take on debt, and therefore helping our long-term financial picture. And then the war chest of cash and bonds in the investment portfolio is really there to avoid any need to sell stocks after big declines in the market. And again, just trying to do everything we can to increase our odds of success, since we know selling stocks when they're down is something that reduces odds of success over the long term. And so if we can keep our clients having the war chest, then we know that'll help them over the long term. And just one other thing on bonds I wanted to say is the best predictor, as you can see in this chart, of forward returns of bond holdings is just current yields. And given that we're well above 4% now on bond yields for risk-free treasuries, the war chest we talked about on the previous slide is now a positive contributor to portfolio returns. And that's something that has not been the case always over the last few years. And so this is just something that's helpful that I wanted to touch on and point out. And then lastly, as we talked about on the first few slides, diversification is something we believe very strongly in. And it comes with accepting the fact that a lot of companies that we own in our equity portfolios are not going to do very well. But in exchange for that, we own a lot of companies, or a few companies that will do very, very well. And historically, this handful of companies, or a small number of companies, I should say, that have done very well have been able to drive index level returns that are very good. And so our hope is that that continues, and our mindset is staying diversified will increase our odds of success, with the focus for us and our clients being on solid, consistent returns compounded over years and over decades can really lead to really fabulous outcomes for our clients. And this is just a visual illustration of that point that I made on the last slide for diversification, helping achieve solid results over time. So in any given year, you'll see the asset class that does the best ranges from small cap stocks, large cap stocks, equities, cash, and real estate and commodities. But if you look at this white line or white box with the black line going through the middle of the chart, if you own a diversified portfolio, you don't do the best or the worst in any given year, but you do pretty well. And if you can do pretty well over a long period of time, that's a really good outcome. So that's where our mindset and our focus is for us and our clients. Equity investing has been made essentially free in modern times, with commissions and management fees getting competed down to almost nothing on ETFs. So in the strict financial sense, Owning stocks is basically free, but there is still a price of admission, as you can see on this chart, and that is volatility. And it's the price of admission because owning stocks can be very expensive if you own them and then sell them after they go down. And what's striking about this chart is the number of years where the market went down 10+% within the year, but then still finished higher by the end of the year. And if you look at the average of those red dots, the average decline in any given year is 14%, and yet 75% of the time the market still finished higher for the year. So just wanted to put this in perspective, especially sitting here in mid-March of 2025 with the market having gone down 10% from peak to the levels we saw last week. This is one of my favorite slides because I think we can all relate to it, and it's how our emotions change depending on investment performance. And I think we've all felt like the guy in the green cape there on the top, where we're high-fiving everybody for the great performance that we've seen. And then we've also been the guy with the white flag and the despondent guy with his head between his legs there on the bottom and feeling like we messed up when the market's gone down and our portfolios have declined in value. And I showed this slide just to highlight we here at Birchwood try and put our clients in position to have a plan for long-term success. And if we have a plan that we can stick to and not let our emotions lead us to suboptimal decisions, then that's really going to lead to the best performance we can achieve over time. So just by being aware of these emotions, we can avoid letting them lead to suboptimal decisions. Apologies for the busy chart here, but I think it's really helpful, so I wanted to go through it. So this stock really shows annualized returns depending on when you bought stocks and for how long you held them. And so just to drive this home, if we look at this line for 2008, if you bought stocks January 1st of 2008 and owned them through December 31st of 2008, you were down 37%, which is pretty painful, to say the least. But if you held stocks for the following 15 years for a 16-year total holding period, you realize 10% annualized returns over that time frame. So despite the fact that your portfolio lost over a third of its value within the first year, you were still able to achieve 10% returns annualized. And the same point can be made for the dot-com bubble in the early 2000s, where you took some pain early on by buying at recent highs, and yet if you held on long enough, you were able to still get nice high single, low double-digit annualized returns, and we don't see any reason for that not to hold going forward. And along those lines, there's a phrase out there which says time in the market is much better and more important than timing the market. And this chart from JP Morgan shows your cumulative 20-year returns from 2005 through end of last year were almost cut in half by missing only 10 trading days, which is equivalent to 0.2% of all trading days during that time frame. And using March of 2020 as an example, as you can see here in the box, the second worst day of 2020, which was March 12th, was immediately followed by the second best day. So there's a saying out there, which is the night is darkest before the dawn. And oftentimes that's true in investing, where you have best days often following the worst days, or really good days following really bad days. So just being able to hold on when the market's going down in exchange for being there when the market goes back up really does wonders for your long-term returns, as you see here in the bar chart. Valuation is an important topic and definitely an important driver of long-term stock returns. And as you can see, over the past 30 years, we've had times when valuations were low and times when valuations were high. And what we thought would be helpful would be putting the current valuation in context, which is, just above this one standard deviation line, which all else equal is less than ideal because you'd rather own stocks when they're cheap because there's upside from future valuation appreciation. But we thought a couple things were worth touching on with valuation. Number one is this chart on the left, which shows expected earnings growth over the next 3 years. So you can see here 26 and 27, we're expecting earnings growth in the low to mid-teens. And that's much higher than you can see the average level has been over this time frame. And so all else equal, future earnings growth being higher justifies a higher near-term valuation, since the valuation level doesn't look as expensive if you roll forward the time frame a few years. And the second point is this profit margin chart, which shows a pretty consistent increase in profit margins since the early 2000s. And all else equal, a company with higher profit margins is worth more because they can grow earnings without necessarily needing to grow revenues. And so, again, just 2 points we wanted to touch on to put the valuation in context, since both of these things would arguably justify a higher PE ratio for the market. Another topic that's gotten a lot of airtime recently is concentration, and especially this line graph on the top right, which shows the percentage of the S&P 500, which is concentrated in the top 10 companies. So just looking at the last 10 years, you've gone from 17 or 18% up to the mid 30s. So a lot more of your S&P 500 exposure and U.S. equity market exposure overall has been driven by a smaller number of companies. But shifting down to the bar chart below here, I wanted to point out that the earnings contribution from those top 10 companies is 27%. So not far below the mid 30s in terms of market exposure, which is encouraging to me because that shows this increase in concentration has largely been driven by better fundamental performance from those top 10 companies. And this next slide goes into a little bit more detail on that. So there's a lot of information here, but bear with me. So this column here shows the amount of money that each of these 10 companies earned in profits in 2015. And these are all household names. So Apple, Nvidia, Microsoft, Amazon, and so on. And the cumulative earnings of these 10 companies in 2015 was $130 billion, which at the time was about 13% of S&P 500 earnings. And so if we fast forward 10 years to this year, the amount of money these companies are going to make is about $600 billion in earnings, actually closer to 650, which is now 27%, as we saw on the last slide, of the S&P 500's total earnings. And so my point in showing this is the concentration to me is less concerning than it seems at face value because it's been driven by fundamentals and specifically faster earnings growth. So just wanted to put some context around the S&P 500 concentration because I know that's gotten some headlines recently. U.S. economic growth since 1850 is a pretty amazing chart. If you just look at that blue line there in the middle, and this chart's from 2013, so it's a few years old, but I think it probably looks exactly the same if we rolled it forward through 2024 as well. And honestly, this is a pretty amazing graph if you think about everything that's happened in here with the Civil War, the Great Depression, World War I, World War II, just a number of things that have been scary and detrimental to the country and the economy overall, and yet this trend has held true over decades and decades now. And one of my favorite phrases I learned from the past 10 years I've spent investing at different hedge funds is that stocks follow earnings. And by far and away, the number one predictor of stock prices over a long period of time is the amount of money that the companies make. And this graph shows how for the US, since the mid 1940s, earnings and the stock market have essentially moved in tandem. And so thinking back to that last slide with the economic growth being pretty consistent for the US over a very long period of time, economic growth drives corporate earnings, which drives higher stock prices over time. And so as long as the economies continue to grow and corporate earnings continue to grow, stock prices should continue to go up over time as well. One question we've gotten from clients has been thinking about U.S. versus international stock exposure, and I thought this graph was helpful just to show how between 1969 and 2013, so a pretty long time period, the two indexes, both U.S. and international, performed essentially in line, and the average appreciation over that time frame was in the 7 or 8% range. And it's really only since 2013 that the U.S. has outperformed pretty significantly. And going back to the idea that stocks follow earnings, this chart shows how that U.S. stock outperformance we saw on the last slide has really been driven by an increasing portion of U.S. earnings as a percentage of the global equities. And so this chart just shows how international earnings have been declining relative to U.S. earnings, and therefore international stocks have been declining relative to U.S. stocks. So the idea that stocks follow earnings helps us here understanding that the U.S. outperformance, which we see on this slide since 2013, has really been driven by faster earnings growth and faster economic growth as well. So we don't know if that continues, but just wanted to put context around it as people think through this question of U.S. versus international stocks going forward. Two other current events we wanted to hit on. One is the U.S. fiscal situation. So $34 trillion of total federal debt with $28 trillion held by the public, the difference being things like Treasury securities held by the Social Security Trust Fund, so money that the government owes to itself. And if you look at that 28 trillion figure for debt held by the public, you'll see it's roughly the same size as the U.S. economy as measured by GDP at around 29 trillion. And so clicking down to this blue line here, you'll see for a pretty long period of time from the 70s through the early 2000s, the debt to GDP ratio, so the size of the debt relative to the size of the economy, was in a pretty tight range of 25 or 30 to 45 or 50% here. And it's really only since the great financial crisis that we've had a significant increase from 40% all the way up to roughly 100% today. And so the the situation we have of 100% debt to GDP is a pretty recent phenomenon. Is all I was hoping to communicate with this slide. And when do we think that level becomes concerning? Well, our friends at UPenn Wharton, who are experts on this topic, suggest 175% is a level that starts to become scary for sustainability in terms of the country's ability to pay off its debts. And the Congressional Budget Office projects that ratio to come into play in the late 2050s or maybe even into the 2060s, as you can see here by the top line showing the base case projection of the Congressional Budget Office. And the Wall Street Journal had this helpful sensitivity that I wanted to show, which said if you just tweak productivity, which effectively increases GDP growth by half a percentage point relative to the CBO's base case, you see a much less steep line showing only in the 120% range in the late 2050s. So nobody knows what's going to happen, and there's a lot of assumptions involved in this analysis, but my hope in showing this is just to alleviate some of the fears around the doomsday scenarios that get thrown out there and that can lead to conclusions being jumped to by scary headlines and things like that. But there's lots that can happen, and it's not necessarily doom and gloom is all I'm trying to show here. And the last slide for client-related questions we've gotten is tariffs. And so you can see here experts at the biggest banks on Wall Street have quantified the potential direct impact on S&P 500 earnings of about 5 to 8%. And so if you look back at where the market was when Trump started talking about the tariffs, you'll see the S&P declined by about that much. So who knows what happens from here, but one could argue all else equal, tariffs have been priced in, and we'll see where the economy and some of the knock-on effects go. But this was encouraging to me as I stopped to dig through some of the numbers and put the stock moves into context. And lastly, we've been trying to get in touch with the guys at Hindsight Capital. They always invest 100% of the time with perfect hindsight, so they never get anything wrong. And if any of you guys watching this video have contact information for anyone that works there, please send it our way. We'd love to put our own personal money with them as well as your money and the money of our Birchwood clients. So if anyone can get in touch with these guys, please do let us know, because we're big fans of theirs, and we've always admired how they're able to do what they do. And so that's all we had for you guys. So hopefully this was helpful. Please don't hesitate to reach out with any questions. Thanks.